Okay, welcome everyone. We'll start our lesson 3, learning outcome 3, and today we'll go through our LO3, which is learning outcome 3, which is about be able to make financial decision based on financial information. So we'll go through where we can get the financial information, what is meant by financial information, different sources of financial information, why financial information is important, and what sort of the decision we can make based on the financial information. So okay, so we'll start. So before starting today's lesson, first of all, always good to be first, we'll recap what we learned during our last lesson. Anybody remember anything we learned during our previous last 2 lessons? We are doing 3rd lesson now. So lesson 1 we discuss about okay, we'll recap in a few minutes, and then we'll start our lesson. So today's lesson is contents. It's slightly mixed up with the financial accounting, whatever given by the awarding body terminology, introduction to debt, introduction to credit, book of prime entry. Book of prime entry is known as sale day book. So just a sale day book, purchase, where we record the purchase day book is known as a book of prime entry. Book of prime entry. Then we have a ledgers. Ledgers is mean each individual accounts is called ledgers. Like the wages, where we can record all the wages, that's a ledger. And then all the ledgers will be reconciled into trial balance. And the trial balance is, if you're a bookkeeper, you're supposed to be prepare the accounts up to the trial balance. And after the trial balance is the job of accountant to prepare the final accounts. So do we know what those are, final accounts, and why we need to be prepared in accounts? So which we'll go through. Final accounts, we have 4 types of statement. So first is a statement, final account, statement of comprehensive income, which is also known as profit and loss account. I can hear you. I think so you need to click where this little microphone, and you need to pick the, are you using mobile or you using via your desktop or laptop, so then you can hear me, hope so, and I can hear you as well. So statement of comprehensive income, profit and loss, where we show the income and expenses. So if you want to get the information about any company about income and expenses, you can find the statement of comprehensive income, which is also known as the income statement, and profit and loss. Second statement is called statement of financial position, where we can get the information about assets, about liability, and about capital. And this statement also known as balance sheet. A couple of you maybe heard about with the name of balance sheet. So it shows our asset, how much property, plant, equipment we have, how much is a liability we owe it to pay to the bank or various other lenders, or we call creditors, and capital is mean the investment in shares. And okay, next statement is called statement of cash flow, how much money in and out from the business in certain period of time. So it shows inflow and outflow of the cash, inflow and outflow of the cash during certain period of time. Good to be known and check about the financial position of the company and the cash position of the company. Next statement is called statement of change in equity. Equity is known as share capital. Share capital is how many shares we issue, how much dividend we pay during year to our shareholders, how much is the revaluation of the assets. So all this goes into our statement of change in equity. So that's all about, and we learn about types of ownership: sole trader, partnership, limited company, or charity. You can start as a business if you want to start. So that's we learn about the basic, and all this, these are, then we have, which is more linked to the financial accounting. These are the statements we prepare, but actually our subject is the management and cost, is more focused about is our sources of finance, and we need to be focused about how we'll make the budget and then things, that's the key element. Okay, then of course we can go through this lesson a bit more. I'll mention you, but we have last, in the next lesson we'll go through the ratio and different ratios. We can use it to make the decision based on the ratio. So if we look into back to our course contents, which is slightly the inductive contents is not reflecting properly in the learning outcome, but overall it's fine. It's not an issue. It's whatever the awarding body gave us, so we'll carry on follow as it is. So we're doing diploma in accounting, and you doing we're doing OTHM level 4 diploma in business management. Yes, go through diploma in account, diploma in business management, and we're doing OTHM level 4. So hope so you all have access on it. Yes, and then this one we are doing right qualification, and if we look, we are doing the subject is called Introduction to Finance. Yes, and up to now we done 2 lessons. Those are all recorded, and you all have all the evidence there as well with the PowerPoint slides, and we have okay all the resources there as well. So let's this one we doing. Yes. So we done 1.1 is assess the benefit and limitation different sources of finance. We discuss, where we can, internal, external, equity, debt financing, all we discuss. Second lesson, we discuss about different sources in the cost and different, the information, what to help, and we discuss about weightage, average cost of capital, and different model. We said debt is cheaper than equity because the debt is also allowed the tax, exemptions as well on the debt. That is mean borrow money. Today we are doing 3 learning outcome, 3 analyze the budget, and we need to be, so is the key, you will see there is a budget, but when we look the inductive contents of 3 is more they mention about debit and credit. Budget is all about the financial plan, and little bit is a discussion here previous period budget. So that's our key focus should be on the budget and types of budget. And then we'll calculate the cost, how we can calculate the cost and make the pricing decision based on the costing, and assess the investment appraisal. Appraisal mean, how we can decide which one, where we invest, how much we will invest, when you will invest. So that's all will be focused in. Okay, so let's please. Okay, can you hear me? I think so. I didn't mute you. Your mic is muted on your end. So check it or rejoin it. It should be turned off. So I didn't because I can't really unmute it because you muted your end. Okay, let's please. Now is muted and everyone else. So I unmuted it. You're not muted from my end. So please check kindly. Okay, next please. We'll go through now 3.1. 3.1 is about budget, and we'll go through. So budget is a financial plan for futures, and always when we'll make the budget, always you look around and forecast the sale forecast. And the sales, all the budget is based on the sale forecast. The quantity of the sale forecast is often the key. Budget forecast are the factor you that determine the sale forecast give a help to make the sale budget, and the basis of the sale make budget. If the say you expected your sales will go up, like think about now due to the COVID-19, yes, we have a high sale of mask, yes, So think about mask product, protective equipment. So that's a huge, demand. So we can say the sale will go up, maybe even is more than 50%, or some say 400% sales is went up of these equipment, or these, the material. If the sales go up, so you need to be plan your production. Yes, you're expecting sales. So production is, budget need to be increased. So you need more staff, you need more material to make a budget for it, and you need to produce more because sale is there, demand is there. And then the material uses, you need to be find how much material we need to be buy, how much, staff, how much labor or new staff we need to recruit to meet the demands of the product which we are expecting, the material purchase budget. So all budget is a link with the sale. If the sale is a slowdown, all these budget will be reduced, them we don't need a lot of, the budget. So budget is all about, if we making the production budget, sale plus closing inventory minus opening inventory, so we can say how many units we supposed to be produced. Then we'll make the material budget. If we make the material budget, material used in the production, how much it need to be, plus the closing inventory minus opening inventory, and we can find how much material we need to be purchased. So that's the way we can make it budget. Period 1 is a 6 week long, and the production is carried out 6 day a week, and the budget is the sale volume 1200. Closing inventory is the sufficient 3 days, and 6 weeks into 6 days. So we need to be look around the 1200 units. Yes, so we need to be find how many units, we need to be produced. So this way we can prepare the budget and the budgetary control, which we'll go through in the further slides, and I'll send you some, extra budget slides as well. That's also help you. Okay, next we have a master budget. What is meant by master budget? Master budget mean overall budget. So sale budget is can be our master, that leads to all other budget. Or the master budget in other, we can say is the capital expenditure budget. Like capital expenditure mean the expensing major money is on the plant machinery. Yes, so is non-current asset, fixed asset which we use. So that is called master budget. So master budget as a whole country budget is also known as a master budget. Okay. Then when you prepare the budget, please always keep in mind, sometime in a product can be rejected product, some finished goods. So finished goods is a rejected. You need to be make sure, because some product are faulty. You need to be make sure more than that. If we'll say 10% of our production goods are faulty, so you need to make it 110, not 100, because to meet the demand. Yes, so demand is 100 there. So if you're making less, of course we will be short and we're not satisfied. So wastage always we need to be keep in mind as well. So how much is the wastage in terms of material? So we have enough material to produce. Inefficiency always we need to look around the labor hour, wastage time, idle time as well, and we need to be embedded in our. So that's we need to be make sure we use effectively. And inefficiencies always will try to reduce them in a business, so our business run effectively. Okay, we'll go through this approach now. Suppose 12% is a gross production, is a rejected end of the production. So this can be expressed mean whatever you produce, that will be not 100%, that will be 98%. So what you can do, you can time by 100 divided by 98, so you can find how much which we'll go through example here. Let's say total production required, we have to produce 2940 units to meet our sale demands, and the 2940 is the 2% rejection. So times by 100 divided by 90, because this 2940 is the 98% of my, I need to make it 100%. So I should produce it 3000 unit, that will meet my demand of the product will be 2940, because the 10% will be waste. So sorry, 2% will be waste. 2% waste mean that's a 60 unit will be goes toward the waste. Okay, then each unit J requires 4.5 kg of material. 10% of the material is evaporate, like think about oil, and it goes in the environment is evaporator. So we need to be make 10%. So this will be the 90%. So what is the material required in usage? So we need to produce 1000 units. 1000 unit times 4.5. So it means we required 4500 kg material. So 45. So because 10% we need to be look around the waste as well. So 4500 times 100 divided by 90. So we required actually 5000 kg of material. So when we'll make the budget, we'll consider 5000, not 4,500. So that's the way we need to be look around. If the good 900, that's the labor hour. So 90% of the labor is efficient compared. 10% times can be waste, you know. So 9,000 hour required. So 9,000 hours is the 90% of. So we actually hours we required 9,000 times by 100 divided by 90. We required actually 10,000 hours instead of 9,000 hour extra because that 10% hours is the waste. So that's the way we can calculate. Okay, guys, any question, anyone, if you have, you can chat or you can drop me email. Okay, incorporating waste into the budget, always, you know, we need to be incorporate waste into the budget, and we need to be sales, closing inventory, minus opening inventory, changes in the inventory, and reject in the faulty units, and we need to be added, and then we can say this is my production budget is required, what I supposed to be produced. Okay, overall overhead budget we can prepare as well. Budgeted operating statement we can, so sales minus cost of sales, and then of course we can find the gross profit. Then we have overhead, we can find the operating profit, and that information is very crucial in terms of the management accounting. But capital budget is mean spending money on assets. What type of asset? Fixed asset. Fixed asset mean plant, machinery. Yes, so these are the fixed asset. And the integrity of the budget. Integrity mean honesty. Yes, integrity mean honesty. Budget reflects, you know, true. You know, a lot of especially politicians always say, oh, I will do this and that, but they're not honest sometimes with the public, because where the money will come from, that's the question mark. They wish to do it, they want to do it, but where the money, how you manage the resources of the country, you know, that's the crucial thing. And which is we need to be look around. Okay, next we're looking 3.2 explain. 3.2 explain the calculation of the unit cost. So when we calculate the unit cost, we need a unit cost card. Direct material, how much required, direct labor, how much required, other direct expenses. If you add them together, we call prime cost or the direct cost. If you add overhead production, overhead mean indirect cost, which is you add them like a material, packaging and things, those are, and that'll give you the production cost. Then you have a non-production overhead, which is a selling and distribution department, administration department, finance cost, also known as if you borrow money, you have to pay interest on it. That's cost, total cost now. Okay, which we can calculate. And then we have a different costing method. We can use it in management accounting. Yes, it depends, you know, what nature of the business you're in, and you have to decide which method is the best for you. Batch costing, if you're making things in the batches, think about, you know, the little clip pins or paper pins we are making, that can be batches. Absorption costing is also known as a full cost, where we observe fixed and variable cost. Fixed and variable cost. Fixed cost like rent and rate will stay the same in the 12 months, won't change. That's a fixed cost. Variable cost, the cost which change. Job costing is the job. Think about the builders is have a different they are, let's say you want to extend the house, that they have a site 1, site 2, site 3. So each job they give the cost and the benefit, they say how much profit they will make each site. So that's the job costing, which is we can each job we can measure the cost and benefit analysis. And the next we have a marginal cost. Marginal cost is known as a variable cost, where we calculate all the variable costs, and the fixed cost is known as a periodic cost, as a period cost. And the process costing is also known as you know, think about we making furniture, the wood and the finishing and the joining, all these are the process, and each process we can calculate the cost. Okay, ABC costing is known as activity-based costing, and activity-based costing is a look, if you increase the activity, your cost will increase. Look around the example. We have a 10,000 cost of delivery in the delivery department house. So there are the 1,000 deliveries. So what is the per delivery cost? 10,000 divided by 1,000 is a 10 pound per delivery is cost. So 2,000 of these deliveries related to product X, and product X is make 2,000 units we deliver. So what is 2,000 unit divided by 2,000 unit, but 200 deliveries related to 200 times 10. So 2,000 is the delivery cost that's related to product X. So 2,000 divided by 2,000 units, that's a 1 pound. So every product 1 pound delivery cost we need to be observed, and who drive the cost? It's cost driver. So always we need to be find that which thing is drive your cost, and that if you reduce that drivers which drive the other activity, the cost will be reduced. If you manage well your delivery plan, you not send the lorries every day to every customer. If you do the route planning, your cost will go down. Okay, then we have a job costing as mentioned, the builders and the contract, that's a contract costing, which is quite good concept, but has got some drawbacks and activities. The batch costing is total batch cost divided by the number of units you can find per what is cost per unit as a. Then the service costing is in the service industry like NHS and various other, the service provider, they use the service costing. And service costing, guys, always, because think about the service is because the human being, human mood. So it's the intangible. You can't see it simultaneously instant. You have to do perishable. It's not. It can't be stored. It's a expired. And a heterogeneous. It's very difficult to be standardize your service because of course you want to be, but still is the human natures and the interaction. So that's why you may be heard. First impression is the last impression. Last impression is the first impression. Okay, then because we are doing the cost, the unit cost. Think about here, we are using material A and B, two types of material required to make one product. That's 6 kg, 2 kg is required. Total cost is this, and that's 18 pound worth of the material required. Two types of labor required. Those are skilled labor, unskilled labor. Their hours, and we required. That's 58 pound worth of the labor required. When we add these two direct costs is the prime cost, direct cost towards is 76 pound and 50 pence. Then we have a very variable overhead that are related to the production, that's 1 pound, and that's 8 pound worth of. Then we have a fixed production overhead that's also related to the production, that's 24 pound worth of. So total cost to make one unit is 108 pound, and standard costing is always good to be weigh the variance. So standard cost minus actual cost, the difference will be variance. So if the national minimum wage will increase, this will be, if the wasted time is there a log, or if the material is scrap, and that's increase the cost per unit, then of course your profit margin will be drop. And as well as the standard you need to be set, and you need to be focused on the standard. Okay, next now 3.3. we have a pricing decision. Price decision is very, very important in what price, because the price is represent. If you charge low price, that's also is a problem. People think is the quality of the product is not good. If you charge too high price, that maybe people can't afford it to be. So which need to be look around what is actual the price in the market and what cost me, and all these decision we need to be based. The company intend to hire the machinery and the cost is 200,000 per annum. However, they enable 60,000 units per annum to be produced. Additional machines can be hired 80,000 per annum, and each machine has the capacity to make 20,000 units, but not the possible to increase the production beyond the 90,000 because the shortage of the space. The minimum rental period, the variable cost is 6 pound per unit produced. So no fixed cost can be specified or traced within the product. The material marketing management estimated selling price range can be of the output. This and this, the estimated as follows. So we can look around. So we'll go through here. You will see there, if we'll sold the units and produce and sold, you will see, and what will be the selling price of these. So we can multiply these each. So we have each unit, we have a variable cost and price per unit, which is a selling price minus variable cost. So that will mean give me contribution, and then times by the number of units you sold. So you can find what will be total contribution. So that's, if you do 16 times, yes. So you need to be make sure we'll do the contribution. So that's the contribution in pounds, which we can calculate, and then that's the 800,000, 840,000, 940, 960. So if we'll sell 90,000 units and the contribution is coming 960,000, let's say fixed cost and my full, the profit will be 600. So that's a more economical way. So when we decided decision making, so we can make a decision. So we'll carry on up to the 90 because that's our full capacity. It will go to 90 plus, maybe our cost will go up, so you will see there, that's the contribution, but there is a fixed cost as well, but profit will be less profit. So it's a no point, we'll go beyond that point and we'll carry on doing, so that's the way we can make the decision which one is. So we can marginal revenue is mean there are, if we produce unit, what is the price, you will see there. If you carry on producing more and more, what is the margin? Margin means every successive units, what is the revenue will generate and what will be the marginal revenue. Yes, additional revenue. So you will see 40, 120 difference is the 50. So your marginal revenue is carry on dropping and will reach that point where it can be a negative. So it's no point to go through. The next we have a situation where we call the skimming pricing. Skimming mean is a high price like due to the quality. When we have a good quality, good reputation of the company, we can charge the high price. If you charge the low price, think about Holiday Inn, Marriott and very other hotel. Think about Marks and Spencer next compared to Primark and the other low quality. And if it's a low quality product at the short period of time, you can charge the penetration price is a low price at the start of the business. Maybe you charge the low price, and when it's peak, you can charge the high price as well. That's called price penetration strategy. Product line, it can be if you produce more, if you buy more, you can be charged more and less price based on the volume, and you can give the volume discount, or we call bulk discount, accordingly. That can be one of. Cost can be cost based approach. So whatever the cost, you're adding the margin or the markup, what is for 20% you want to be sell higher than the cost, and 20% you want to be profit. So you can decide the price based on. Okay, then the market-based approach, also known as a competitor-based price. Competitor-based price, what your competitor do, you just follow them and you charge the price accordingly. Okay, sorry, I'm not reading every slide, but I'm just giving you the concept. Okay, and you can try to be read fully, yes, if any questions still. Okay, then practical method of transfer pricing, different location and different pricing can be, and it's a process costing as well. We can use the transfer pricing. So we need to be make sure we can maximize our return. That's the question we've been given. I added the scenario just to give you as a homework. Please make sure you read it. That will help you to understand. I copied the link, the pricing, the CN and the quiz as well to do. Please attempt that quiz. You can copy this link and do it. And you can watch the video as well, pricing the CN, which is quite good to watch. And further you develop to understand the concept of pricing the CN based on the costing. Then 3.4, we have assessed the viability of the product. Investment appraisal. Appraisal. What is meant by appraisal? Appraisal means checking the performance of someone. Appraisal always equal to in time, in cost, and in quality. When you do, somebody is checking the performance, I look so how much somebody spend the time, how much somebody use the material, and how much someone is the quality, the customer, the client deal is, what is the customer satisfaction level. So then you can measure the performance. Or you learn about different appraisal methods as well, 360-degree or various. In financial, we'll do the investment appraisal, how much is payback period, how long the money you invest will take you to recover it. Net present value is mean the what you invest, how long will take you, and what will be the real value. Internal rate of return is other concept where we also look around two options, and where internally rate, what is the return rate will be. Sensitive is always we measure the risk. Break even where no profit, no loss. Average rate of return, what will be average rate of return, we can look around very option. So time value of money is a concept where we can look around. The pound today is more value the pound you will get in future. So that's why we discount it, and we can look around the future money which we'll get. The payback period, initial investment divided by annual cash flows, which we'll go through. It's quite easy to understand the concept. What you invest, how long will it take you, what is the drawback. This don't keep in mind the value of the money and ignore the value of the money. That's the key disadvantage of this method. So let's please we'll go through. Here is example of payback. Year zero is mean the current year. When we invested 3,100 pound, we getting £1,000 back, £900 back. So if each year money is coming back as a profit, so 3,100 is went outside the business, and we getting 1,000 back. Still we have to recover the 2,100, then you're getting the 1,200, and then 200 remaining to cover. Then we have a 400 remaining to cover. End of 3 years, it's 400 left to be recovered. So it means now this project will take 3 years and some months. So outstanding amount end of 3 years, and the following year I'm getting 500. So I can't say it take me 4 years to recover my 3,100. It will take 3 years and some months. So outstanding amount, which is this 400 divided by 500 times by 12 months in a year. So you can say this project will take 10 months, 3 years and 10 months to be recover my 3,100. So the payback period, I can compare with other projects if that project will give me three years, so I'll go for the 3 years, not 3 years, 10 months. So always shorter payback is a better, and we'll decide on the basis of. And the net present value is the future cash flow. Then always we need to be look around, and always good method to be look around. The £10 today is more worth it. The £10 you will get after 1 year. Even if you get £11, so you need to be checked what will be the £11 value in the after 1 year, keeping in view of the inflation and the cost of capital. So next, now we use the discount factor tables, and we can use the formula as well. Formula is a 1 divided by 1 plus R. R is a discount factor, or we can depreciate the value of the money. 1 divided by, if you do 1 in the formula and 10%, we can write 0.1. If you write it like this and you divide it now, and what's it come? 10, you can write 0.1. Yes, you can say 1.1. If you do now 1 divided by 1.1, and that will be your discount factor. You can do on 20%, 30%, whatever you will be, you want to use it. So we'll go through. So let's please, if you do 1 divided by 1.1, I'm discounting. Normally we've been given NPV table, so we just, so your answer is 9. So after 1 year, £1 value will be 909. So in the year 2, you carry on dividing on 1.1, whatever. So that will be depreciate. It will be 82 pence approximate. In the next year, in the year 3, it will carry on depreciating with 1.1. So that will be now it's 75 pence. So what we'll do, if you're getting you're investing 20,000, that's you went out, because the current year is a £1 is a £1. Then 5,000 you're getting, so 5,000 times 909. Then so if you're getting 5,000, actually real value of 5,000 will be £4,545. So you add all the positive figures. So what you do now, so look there, you add it all the positive figures, which is 4545 plus 5782, yes, and plus 6008. So you getting the money real on the real value is 16,000, and you investing 20,000. So if you minus 20,000, so NPV is coming negative. Yes, is the negative figure is higher than the positive figure. So we reject the project. We're not going to invest in this project because the NPV on the base of the 10% is a negative. So maybe you can reduce the factor to 8%, 5% based on looking the inflation, or if you deposit money in the banks. If you look on the 8%, and then you will see there one other example. So you can add all the positive NPVs here coming positive. We accept the project. Otherwise, we reject the project. So that's the way we can look around and we can decide, investment appraisal. And other is the interest rate, where we look two NPVs, higher and the lower. This is the formula. L is represent the lower rate of interest is like 10% and 15%. Higher NPVs and the lower NPVs, we can apply this formula to calculate, and this is the advantages and disadvantages. Good to be look around internally rate of return, where we can calculate this formula by using. Then is the average rate of return, average profit, and divided by initial capital. And you look, we have a 3 project, Andover, Bristol, and Carlisle. We investing 4 million at the start, 1 million we are getting total. We getting in 1, 2, 3, 5 million. 4 million we invested, so there is a profit 1 million. 1 million and we are getting in 5 years, so it's coming average profit 0.2. 0.2 divided by 4 million times by 100, so we are getting 5%. Yes, by using the formula we are getting 5% there and 8%. So we have a 3 option to invest. This 2 project require the same investment, same return, but B is a better because you will get earlier, and the earlier you will get the more inflow, and the later years you will get even the percentage is the same. So we'll prefer to B instead of A. And if you look the Carlisle, but the Carlisle is a higher return, but only the problem is required 5 million investment. If we don't have a 5 million, we'll go for B, from B and A, and otherwise we can go for C is a better because it's the 8% return. So that's the way we can appraise the project, which one is a better, which one is not, and we can make the decision to be invest or not invest. So guys, I'm giving you this example. Further, you can use it, to be calculate which project is a better. And further, we need to be good to be look around some investment appraisal quizzes. So investment appraisal quiz, and yes, so I'll copy the link for you, and you do in your own time. That also help you to clear your understanding. And if you have any question, you can drop me email as well, and I'll get back to you. So make sure you do this quiz. Yes, I'll add one video for you as well, so that you can use it to. Yes, so what we'll do now. Okay, so video and investment appraisal. Yes, and I can say tutor to you. Yes, so these are the slides, and for the if you want to be how we can make the decision extras, so please go through this. Okay, so that's all, today lesson. So today lesson we discuss about costing method, we discuss about Parliamentary, and how we can make the decision about the pricing, and that's all we learn. If you have any question, drop me emails or emails on these two email addresses, and I hope so I'll speak to you during our next lesson. Thanks for listening, thanks for attending, thank you, bye bye.